Now that we've looked at the asset section of the balance sheet, we'd be moving on to the second half, which is the liabilities section. Now, just like your asset section, your liabilities section starts off with current liabilities. Now, these are liabilities that take cash away from your business in the next 12 months. So think of it as the opposite of current assets. Your current assets are things that bring you in money for the first 12 months. Your current liabilities are the ones that take out that money. So the current liability starts off with something called accounts payables, and to keep it very simple, these are just bills, right? Generally, when you have a company, you've got other companies that ship you out materials or equipment or things you need to make your product, and it's usually done on credit. And as soon as you've had your inventory shipped out, or when you have your cash coming in, you have to pay off these credit. So think of it as like a credit card for your business. You've taken out a loan, and then you need to sort of pay it back minus the interest usually. Now, when a company usually receives materials, the company can either pay the money upfront in cash, or they can sort of sit on it, wait, and say that, all right, we're going to build the product, and then we're going to ship it out, and once the profit comes in, we're going to give the money out. And this process is called accounts payable. The second section is accrued expenses. Now, these are monetary obligations, quite similar to accounts payable. So think of it this way, right? If you have a business, it uses different sort of classifications depending on who the debt is owed to. So accrued expenses are things like salaries, which you have to pay out for your employees, but it's not paid out yet, or lawyer's bill that's not been paid out yet. Interest due on some of the merchandise you've bought, or an equipment you've bought that you haven't been paid out yet. So these are expenses that sort of have accrued up that you need to pay out. And the best way to think of it is, think of this as like salary breakdown that needs to be paid out, or lawyer retainer that needs to be paid out, so on and so forth. Now, the next liability that we have is something called current portion of debt. So current portion of debt. Now, imagine your business takes out a loan, all right, and the overall term for the loan is maybe 5 years. Now, you will have a certain component of that loan that needs to be paid out within 12 months, right? This is called the current portion of long-term debt, which is basically an amount that's due for payment within 12 months, and hence it gets listed on the current liabilities. Now, the rest of the loan might go into the long-term debt section, which we're going to go through in a minute later, but a certain percentage of that debt or that loan is going to have to be paid off in the next 12 months, which becomes your current portion of debt. Now, the fourth one you have is income tax payables. So for income tax. Now, every time your company sells something and makes a profit on that sale, a percentage of that profit is owed to the government in the form of income taxes. Income tax payables are income taxes that the company owes the government, but that the company has not yet paid. And every 3 months or so, the company will send the government a check for your income taxes owed. For the time between when the profit was made and the time when the tax are actually paid, the company will show the amount to be paid as an income tax payable. Now, in order to find your current liabilities, again, it's just the same. You add all the four sections, and that gives you your current liability. So you have your accounts payable, then you have your accrued expenses, you add it with your current portion of debt, and then your income tax, and adding all those together is going to give you your current liabilities, which make up the first section of the liabilities in the balance sheet.